The markets are, I don't want to say reacting, but oil is down almost about 5%, which is interesting. Let's talk about the stock side of this and bring in Julian Emanuel. He is Senior Managing Director at Evercore ISI, and Paul Christopher, Head of Global Investment Strategy at Wells Fargo Investment Institute. Julian, I'll start with you. Obviously, not why you guys are on or what you thought you would talk about, but I have to address it. How do you, as strategists and fund managers, Julian, how do you factor this into any of your models?
It's very difficult, clearly. So, look, coming into what's happened over the last few days, stocks were relatively expensive on 23.5 times. So given the fact that we were still looking at the tax bill to be negotiated and tariffs, it was likely that the market was going to churn, as it has been anyway. But if you put this on top, I think for us, what we've seen over the last 90 minutes is a logical response to what the market is believing for now is basically a de-escalated type of response from Iran. And so, again, there is this uncertainty that's going to hang over as we see what, in fact, happens with either missiles going to Iraq or Bahrain, as they suggested could be the case.
Yeah, Paul, same question to you. Does this change anything that you may have thought about vis-a-vis the equity market and your clients?
No, the short answer is it doesn't change what we've been thinking about and what we've been talking about. This just extends the list that you mentioned earlier that includes the big, beautiful bill in Congress, as it's formally named, as well as the pause ending for the tariff pauses. Those are ending in July and in August. And so you just add one more item to the list here, and it makes you go back and look at your economic models and say, well, look, we still see a slowing economy, but one that we think avoids recession this year. And if we get the Fed to cut rates at least once later on this year, and we see some productivity gains going forward, we see some deregulation going forward, we think the economy and the markets do well through 2026. So then this whole list of uncertainties becomes something maybe to look through and to maybe cling more towards quality here and wait for the pullback. We agree the market has been overbought. It's been on momentum, on fumes. 23.5 times earnings is too high. We'll look for that pullback and then look for an opportunity to buy, expecting that recovery into 2026.
Yeah, and by the way, here is the video again of incoming Iranian missiles being intercepted by U.S. or Qatari defense systems, literally blowing a missile out of the sky with another missile. Remnants of what we saw sort of a week ago over Tel Aviv. It's powerful stuff. And luckily, guys, it looks like everybody is okay, both in the city of Doha and of the U.S. Air Base. But, you know, Julian, I'm not going to lie. I'm a little bit surprised. I understand what Rothschild said. You buy at the sound of cannons and you sell at the sound of trumpets. Basically, the idea being that when things go bad, that's when you should be buying in the equity market. I'm a little vexed by the price of oil. Are you surprised by the market's seeming lack of reaction to what we're seeing on the screen right now?
No, because if you go back and remember, the last time OPEC raised output was in early May, and you had oil prices respond by moving higher over that time. So there's an element of the whole scenario maybe not being fully discounted, but there was, clearly, and you heard rhetoric around the warnings that Trump had given them 60 days, et cetera. So I think there was an element of preparedness in terms of the price response. And to us, you're just really in one of these phases. When you look at the bigger picture, oil where it is now is not enough to derail the bull market that started in April. Is it enough to stall it? Very possibly, but not derail it.